This is not news. This is risk assessment. For developments this week are reshaping the global power structure, and most business owners are missing the signals. We're tracking economic coercion in the Arctic, a trade bloc that took 25 years to build, a new commercial axis forming in the Pacific, and an eerie silence descending over one of the world's most volatile capitals. Each of these movements has direct consequences for supply chains, currency flows, and strategic positioning. Let's break down what's happening, what's not being said, and what it means for capital allocation. Before we dive in, if you're finding value in this analysis, hit the like button. Leave a comment below with which of these risks concerns you most, and share this with someone in your network who needs to see these signals before they become heddle. First news: Greenland. Under economic siege, the Arctic power play no one's pricing, and here's what's happening right now. Donald Trump has issued a direct threat: impose tariffs on any nation that opposes American annexation of Greenland. This isn't diplomatic posturing. This is economic warfare being deployed to secure territorial control. The stated reason: national security. The real reason: strategic dominance over the Arctic as climate change opens new shipping routes and reveals massive mineral deposits. Let's look at what was actually said. Trump explicitly warned that countries blocking this annexation would face punitive trade measures, not sanctions in the traditional sense, tariffs. Direct economic pressure on allied nations to accept American territorial expansion. Now, multiple countries are responding not with words, but with military deployments. NATO members are reinforcing troop presence in the Arctic region. Think about what's not being highlighted here. This is the first time in modern history that a U.S. administration has openly threatened economic retaliation against allies for opposing territorial acquisition. That's not a policy shift, that's a doctrine change. Greenland holds rare earth minerals critical for technology manufacturing. It sits on potential oil and gas reserves, and most importantly, it controls access to Arctic shipping lanes that could reduce trade routes between Asia and Europe by thousands of miles. When those lanes fully open, whoever controls Greenland controls a choke point more valuable than the Suez Canal. Here's the risk structure most analysts are missing. If Trump follows through with tariff threats, we're looking at potential trade disruptions with Denmark, which currently governs Greenland. Denmark is an EU member. Tariffs on Denmark could trigger reciprocal measures from Brussels, opening a trade war on a second front while the U.S. is already managing tensions with China. For businesses, this creates currency volatility in the euro and Danish krone. It puts pressure on transatlantic supply chains, and it signals that territorial disputes, once thought buried in the 20th century, are back as tools of economic statecraft. Who's moving troops? Norway, Canada, Denmark itself. These aren't symbolic gestures. These are defensive preparations for what they clearly see as an escalating confrontation. And here's what should concern every investor. When military assets start moving, insurance premiums follow, shipping costs rise, trade routes get repriced. For risk, if you have exposure to Arctic resource companies, European equities tied to Danish trade, or logistics firms dependent on stable North Atlantic routes, you need to model this scenario now, because the window between threat and action is closing. This isn't about whether Trump can actually annex Greenland. He probably can't, not in any legal sense. But that's not the point. The point is that he's willing to weaponize tariffs against allies to pursue it, and that precedent, once set, changes the entire framework of international trade relations. What's the second-order effect? If the U.S. can threaten economic punishment for territorial opposition, other powers will test the same playbook. China in the South China Sea, Russia in the Caucasus, Turkey in the Eastern Mediterranean. We're not just watching one isolated Arctic dispute. We're watching the return of might makes right as a governing principle in global commerce. The real question isn't whether Greenland becomes American territory. The question is, what does the global trading system look like when territorial ambition becomes a legitimate reason for trade war? That's the risk, and it's accumulating faster than most portfolios are prepared for. If this analysis is connecting dots you hadn't seen before, leave a comment with your take. And if you know other business owners who need this perspective, share this video. Second news: Mercosul-EU agreement finalized. The trade bloc Wall Street isn't watching. 25 years of negotiations just ended. Lula met with Ursula von der Leyen this week and announced that the Mercosul-European Union trade agreement is finalized. The formal signing happened Saturday in Asunción. This creates one of the largest free trade zones in the world, linking South America's Mercosul bloc Brazil, Argentina, Uruguay, Paraguay with the entire European Union. Let's be clear about the scale. We're talking about a combined GDP exceeding $18 trillion, a market of over 700 million people, and the elimination of tariffs on billions of dollars in goods annually for Brazil. This opens European markets to agricultural exports, beef, soybeans, sugar, poultry for the EU. This opens South American markets to automobiles, machinery, pharmaceuticals, and industrial goods. Now, here's what Lula said specifically. He called this agreement the conclusion of a quarter-century process and emphasized that it establishes one of the world's largest free trade areas. Von der Leyen echoed this, framing it as a strategic partnership that strengthens both regions, economically and geopolitically. But here's what's not being emphasized. This agreement fundamentally weakens U.S. trade leverage in South America. For decades, American companies had preferential access to Brazilian and Argentine markets. That advantage just evaporated. European car manufacturers now get tariff-free access to Brazil, the world's seventh-largest automotive market. German industrial equipment gets duty-free entry into Argentina. French pharmaceuticals get cheaper distribution across the southern cone. Meanwhile, American goods still face Mercosul's common external tariff, which ranges from 10 to 35% depending on the product category. Think about the strategic timing. This agreement closes just as Trump returns to the White House with an explicitly protectionist trade agenda. Europe isn't waiting to see if the U.S. will impose new tariffs. They're locking in alternative markets now for investors. This creates opportunity and risk. Opportunity. European exporters with South American exposure just got a major competitive edge. Companies like Volkswagen, Siemens, and LVMH now operate in a tariff-free environment across an entire continent. Risk. U.S. exporters to South America face margin compression. They're now competing against European firms that don't carry the tariff burden. That hits agriculture equipment manufacturers, tech firms, and industrial suppliers particularly hard. There's also a currency angle most people are missing. Mercosul nations have been desperate for hard currency stability. This agreement strengthens the euro's role as a reserve currency in South America, potentially reducing demand for dollar-denominated trade. If Brazilian exporters start invoicing European buyers in euros instead of dollars, that's one less source of dollar demand in global markets. Multiply that across all Mercosul exports to the EU, and you're looking at a meaningful shift in currency flows. Now, let's talk about what this means for commodities. Europe is committing to buy massive quantities of South American agricultural products. That puts a floor under prices for soybeans, corn, and beef. It also creates supply pressure for North American producers, who were counting on European import demand. If you're long U.S. agricultural futures, this agreement just added a new source of competition that wasn't priced in 3 months ago. And here's the geopolitical layer. China has spent the last decade building trade infrastructure in South America through the Belt and Road Initiative. Now Europe is establishing a formal free trade framework that directly competes with Chinese influence. We're watching a three-way competition for South American markets, the U.S. with legacy ties and proximity, China with infrastructure investment, and now Europe with tariff-free access. South American nations are diversifying their partnerships, which reduces their dependence on any single power. That's smart strategy for them. But for businesses in the U.S., Europe, or China, it means the competitive landscape just got significantly more complex. The formal signing is Saturday. The implementation timeline is still being negotiated, but preliminary reports suggest phased tariff reductions beginning within 18 months. If you have business operations in South America, or if you compete with European firms in those markets, you need to model this now, because the competitive advantage you had last year just got redistributed. Which of these trade shifts impacts your business most? Drop a comment below. If this breakdown was useful, hit the like button and share it with your network. Third news: Canada-China tariff deal. The quiet realignment everyone's missing while the world watches U.S.-China tensions. Canada just cut a deal with Beijing. China agreed to reduce tariffs on Canadian canola. Canada agreed to reduce tariffs on Chinese electric vehicles. The agreement was sealed after a direct meeting with Xi Jinping. Let's unpack what actually happened. Canola is Canada's third largest agricultural export. China is the biggest buyer. importing roughly 40% of Canadian canola annually. For years, Beijing used tariff threats on canola as political leverage against Ottawa, particularly during the Huawei executive detention crisis. Now, suddenly, those tariffs are coming down. In exchange, Canada is reducing duties on Chinese EVs. This is significant because Chinese electric vehicle manufacturers like BYD and NIO have been locked out of the North American market by prohibitively high tariffs and regulatory barriers. Canada just opened the door. Here's what officials are saying. Publicly, this is a mutually beneficial trade agreement that supports Canadian farmers and gives Canadian consumers access to affordable electric vehicles. Here's what's not being said. This is Canada hedging against U.S. trade policy. Ottawa knows that a second Trump administration could impose tariffs on Canadian goods. Instead of waiting to get caught in a trade war, Canada is diversifying its export markets and import sources. By cutting a deal with China, Canada gains leverage. If the U.S. threatens tariffs, Canada can credibly threaten to deepen ties with Beijing. Now, think about the supply chain implications. Chinese EVs entering Canada at lower tariff rates will compete directly with American automakers. Ford, GM, and Tesla all sell vehicles in Canada. They just got a new competitor with a 20 to 30% cost advantage. If Chinese EVs gain significant market share in Canada, it puts pressure on North American production. Factories in Michigan and Ontario are built around a certain volume assumption. If that volume drops because consumers are buying cheaper Chinese alternatives, plants close, jobs disappear. There's also an energy angle. Canola is a feedstock for biofuels. By securing Chinese demand for Canadian canola, this agreement stabilizes revenue for Canadian biodiesel producers. That's important because the global biofuel market is under pressure from both fossil fuel price volatility and EV adoption. If Canadian canola exports to China increase, it could tighten global canola supply, pushing prices higher for other buyers, including the U.S. and Europe. For commodity traders, this is a signal to watch canola futures. For energy investors, this is a signal to reassess biofuel production economics. And here's the geopolitical read. Xi Jinping doesn't make trade concessions without a strategic reason. He's giving Canada tariff relief on canola because he wants to fracture North American unity on China policy. If Canada and the U.S. take divergent approaches to Beijing, it weakens the collective bargaining power of both. China can play them against each other. That's classic divide and rule strategy. For businesses, the risk is regulatory divergence. If Canada adopts different standards for Chinese imports than the U.S., it creates compliance complexity for companies operating in both markets. You can't use the same supply chain for both countries if one allows Chinese components and the other bans them. This deal also signals something broader. Mid-tier powers are no longer waiting for the U.S. to set the trade agenda. They're cutting bilateral deals with China, Europe, and each other. The rules-based order everyone talks about is being replaced by a network of bilateral agreements driven by immediate national interest. That makes trade policy less predictable. And less predictability means higher risk premiums across every sector. If you're in agriculture, automotive, or clean energy, this Canada-China deal just changed your competitive environment. The question is, are you positioned for it? Drop a comment with your thoughts on this realignment. If this analysis added value, like the video and send it to someone who needs to see it. Fourth news hearing goes quiet. The silence that should worry you. Here's what's happening in Iran right now. Residents and human rights groups report that Tehran has returned to relative calm. Protests that dominated headlines just weeks ago have largely disappeared. Clashes are now isolated and sporadic. The White House says Donald Trump is monitoring the situation and keeping all options on the table. If deaths continue, let's talk about what that actually means. For weeks, Iran saw mass demonstrations against the regime. Protesters were in the streets. The government responded with force. Deaths were reported. International pressure was building. Now, suddenly, the capital is quiet. There are two possible explanations. One, the protests succeeded in forcing concessions. People went home satisfied, and stability returned organically. Two, the government crushed the movement with sufficient force that resistance collapsed. Which scenario do you think is more likely? Human rights organizations aren't declaring victory. They're noting the quiet with concern. Because in authoritarian regimes, silence doesn't usually mean resolution. It means suppression. When protests stop abruptly without visible policy changes, it means people are too afraid to continue. It means the cost of resistance became higher than the cost of compliance. Now, here's what the White House statement tells us. By saying Trump is keeping all options on the table, they're signaling potential military or economic action if violence resumes. That's not a guarantee of intervention. It's a warning to Tehran, but it's also a signal to markets. Any escalation in U.S.-Iran tensions immediately impacts oil prices. Iran controls the Strait of Hormuz, through which roughly 20% of global oil supply passes. If that strait closes, or even if transit becomes uncertain, Brent crude spikes. We saw this in 2019 when tanker attacks in the Gulf sent oil up 15% in a single week. We saw it again in early 2020 after the Soleimani assassination, right? Now, oil markets are pricing in stability. They're assuming Tehran stays quiet and the U.S. doesn't escalate. But here's the risk. If protests reignite and the Iranian government responds with lethal force, Trump could face domestic pressure to act. Sanctions are already maxed out. The next step is either cyber operations or kinetic strikes. Either one would destabilize the region. Either one would send oil prices higher for businesses dependent on stable energy costs. This is a scenario worth modeling. What happens to your margins if crude jumps to $90 or $100 a barrel? There's also a broader point here about geopolitical risk. Authoritarian regimes don't broadcast their weakness. When they go quiet, it's because they've either consolidated control or they're preparing the next move. Iran just went quiet while tensions with Israel remain high, while proxy groups in Yemen continue attacking shipping, and while nuclear enrichment continues. That's not stability. That's a pause. And pauses end. The fact that the White House is explicitly keeping options open suggests they don't believe this quiet will last either. They're preparing for the next phase. For investors, that means reassessing exposure to Middle Eastern assets, energy sectors, and shipping routes through the Gulf. If you're long oil, this quiet period might be an opportunity to take profits before volatility returns. If you're short, you're betting that Tehran stays calm and Trump stays restrained. That's a risky bet. The silence in Tehran isn't the end of the story. It's the intermission. And intermissions don't last long. Which of these for developments concerns you most? Leave your thoughts in the comments. If this briefing gave you information you weren't seeing elsewhere, like this video and share it with others who need these signals. Subscribe to get this analysis before it becomes mainstream narrative. Closely, we just covered economic coercion in the Arctic, a historic trade realignment in South America, a quiet Canada-China deal that shifts North American competitiveness, and an ominous silence in one of the world's most unstable capitals. None of these are isolated events. They're all part of the same pattern. The global order is being renegotiated in real time, and most people aren't watching closely enough. Who controls Arctic resources? Who dominates South American markets? Who sets the terms of trade with China? Who manages Middle Eastern instability? These questions determine where capital flows, where supply chains break, and where risk accumulates. This isn't news. This is risk assessment. And if you're not tracking these signals, you're operating blind. See you in the next briefing.